One of the most widely circulated arguments right now in the precious metal space is the claim that recent margin increases on silver futures represent a deliberate effort to suppress the rally. It sounds compelling. It sounds historical. And at first glance, it even sounds logical. But when we examine how futures markets actually function and what margin policy really signals, the conclusion becomes far less dramatic than many investors are being led to believe. Yes, the CME recently raised margin requirements on silver futures again. That much is true. But interpreting margin hikes as evidence of systemic intervention against silver investors misunderstands both the role of exchanges and the mechanics of leveraged markets. Margin requirements are not weapons, they are stabilizers, and historically, they tend to rise precisely when volatility, not manipulation, becomes the dominant market force. Let's start with the fundamentals of what margin adjustments actually represent. A margin requirement is not a directional signal. It does not indicate whether prices should rise or fall. Instead, it reflects the exchange's assessment of risk inside the clearing system. When volatility increases and price ranges expand rapidly, as they have recently in silver, the exchange must ensure that counterparties remain solvent. Raising margin requirements protects the integrity of the market itself. In other words, margin hikes follow volatility, they do not create it. This distinction matters because many investors are currently interpreting a defensive institutional adjustment as an offensive intervention against bullish positioning. But exchanges do not profit from forcing liquidations, they profit from maintaining orderly markets. Their incentive structure is stability, not price direction. And once we recognize that reality, the narrative begins to shift. Consider the recent increase in silver margins over the past 45 days. Yes, the increase was meaningful. Yes, it raised the cost of maintaining leveraged positions. But the implication that such adjustments automatically trigger collapses misunderstands how positioning works across the futures curve. Professional capital rarely operates at margin limits. Institutional traders maintain excess collateral buffers specifically to absorb margin changes. The participants most exposed to margin shocks are typically speculative retail leverage flows and short-term momentum traders, not long-horizon strategic investors. That distinction becomes critical when evaluating whether margin adjustments can structurally reverse a bull market. Historically, they cannot. What they can do is remove excess leverage from crowded trades, and that process, while uncomfortable, is often necessary for sustainable price appreciation over longer time horizons. Now consider the comparison frequently made to 2011. The argument suggests that because silver collapsed after multiple margin hikes in April and May of that year, today's margin increases must signal a similar outcome ahead. But that comparison ignores the broader macroeconomic context surrounding the 2011 peak. Silver did not collapse simply because margins rose. Silver collapsed because positioning had reached extreme speculative concentration levels. Real interest rates were turning higher, and global liquidity conditions were tightening at the same time. Margin adjustments were a response to instability already present, not the catalyst that created it. In fact, the 2011 peak occurred during one of the most crowded retail commodity trades of the modern era. Social sentiment was euphoric. ETF participation surged. Momentum flows dominated price discovery. The market was already fragile before the first margin adjustment was announced. Margin hikes accelerated the correction. They did not invent it. This distinction is essential because today's silver market structure is materially different. Current positioning is elevated, but it is not historically extreme. Liquidity conditions remain uneven, but not restrictive. And perhaps most importantly, the macro environment surrounding inflation persistence, fiscal expansion, and currency uncertainty looks nothing like the tightening backdrop that followed the 2011 commodity spike. Which raises a more important question investors should be asking right now. Not whether margins are rising, but whether the underlying liquidity regime supporting precious metals is actually weakening or quietly strengthening beneath the surface. Another argument circulating across the precious metals community right now is that history is repeating itself. Investors are being told that what happened in 1980 with the Hunt brothers and what happened in 2011 during the last major silver spike are unfolding again today, almost step for step. But this comparison sounds convincing only if we ignore the structural differences between those historical episodes and the market environment silver is operating in today. Because when those differences are examined carefully, the parallels begin to weaken very quickly. Let's start with 1980. The Hunt Brothers episode is often described as proof that exchanges change the rules whenever silver rallies too far. But that interpretation oversimplifies what actually happened. The silver market in 1979 and early 1980 was not experiencing a normal bull cycle. It was experiencing a concentration event. A small number of participants accumulated extraordinarily large positions in both physical silver and futures contracts with the explicit objective of controlling supply dynamics. That was not a rally driven by industrial demand. It was not a rally driven by macro hedging flows. And it was not a rally driven by diversified institutional capital. It was a corner attempt. Once position concentration reached levels that threatened market function itself, the exchange imposed liquidation-only rules and sharply increased margin requirements. Those actions were not designed to suppress prices. They were designed to restore market integrity. If they had not been implemented, the clearing system itself could have faced systemic risk. Today's silver market looks nothing like that environment. There is no single dominant buyer attempting to control the physical float. There is no coordinated effort to corner futures delivery channels. And there is no evidence that exchange stability is currently under threat from concentrated positioning. Drawing a direct line between 1980 and today, therefore, introduces more confusion than clarity. Now consider 2011. This comparison appears stronger on the surface because the margin increases that year occurred during a rapid price acceleration phase, similar to what silver has recently experienced. But again, the macro context surrounding that rally was fundamentally different from today's environment. In early 2011, the Federal Reserve had already begun signaling the eventual normalization of policy after the emergency liquidity measures deployed during the financial crisis. Real yields were beginning to stabilize. Commodity markets broadly, not just silver, were reaching cyclical peaks, and investor positioning across multiple asset classes had become heavily momentum-driven rather than structurally defensive. Silver was not rising because investors feared currency instability. Silver was rising because capital was chasing performance. That distinction matters. When price advances are driven primarily by momentum rather than macro hedging demand, they become more vulnerable to reversals once volatility increases. Margin hikes in 2011 accelerated a correction that was already forming underneath the surface. They did not independently create the collapse that followed. Today's environment is different in a critical way. Precious metals are increasingly being accumulated not only as speculative instruments, but as macro hedges against fiscal expansion, currency uncertainty, and long-duration inflation persistence. That changes the character of participation inside the market. It means price movements are influenced less by short-term leverage flows and more by longer-term allocation decisions, and that shifts how margin policy interacts with price behavior. Margin increases can force weak hands to exit positions temporarily. They can reduce speculative exposure during volatile periods, but they cannot unwind structural allocation shifts driven by macro uncertainty. Those flows operate on entirely different time horizons. This is why investors should be cautious about accepting historical analogies too quickly. The silver rallies of 1980 and 2011 were shaped by positioning extremes that are not present today. The current market is being shaped by a different combination of forces: persistent inflation risk, expanding sovereign debt burdens, and a global monetary system that is still adjusting to a decade of unconventional policy. And when the underlying drivers of a rally are different, the outcomes that follow margin adjustments are rarely identical. Another major pillar supporting the bullish silver narrative right now is the widening global supply deficit. Investors are being told that physical inventories are shrinking, industrial demand continues rising, and registered exchange stocks remain historically low. At first glance, this appears to form an airtight case for sustained higher prices. But once again, the conclusion being drawn from the data is not as straightforward as it seems, because supply deficits do not automatically translate into immediate price acceleration. They rarely have. And in commodity markets, especially metals markets, pricing often responds more to liquidity conditions than to physical shortages in the short term. Let's begin with COMEX registered inventory. It is true that registered silver stocks have declined significantly from their peak levels in recent years. That fact has been widely highlighted as evidence that physical supply is tightening inside the delivery system. But registered inventory is only one component of the broader global silver supply chain. It reflects what is immediately available for futures delivery, not the total amount of metal available globally for industrial or investment use. In other words, falling registered inventory signals pressure inside the futures delivery mechanism, mechanism. It does not necessarily signal a global shortage. This distinction matters because the silver price is still primarily discovered through futures markets rather than through direct physical exchange. As long as futures liquidity remains deep and functioning, short-term price behavior can diverge from physical availability for extended periods of time. We have seen this pattern repeatedly across commodity markets. Copper inventories declined sharply between 2004 and 2006, while prices rose gradually rather than explosively. Oil inventories tightened several times during the past 2 decades without producing immediate supply shocks. Even gold has experienced long stretches where physical accumulation increased while prices remained range-bound. Markets adjust slowly to deficits. They rarely respond instantly. Now consider the global silver deficit projections themselves. Estimates suggest that demand has exceeded supply for multiple consecutive years and that the deficit could remain elevated through the current cycle. That is a meaningful signal. But deficits must be interpreted in context. A deficit does not necessarily mean metal is unavailable. It often means above-ground inventories are being drawn down rather than newly mined supply being exhausted. And above-ground inventories can remain substantial even while deficits persist. This is why deficits tend to influence long-term trend direction rather than short-term volatility behavior. Investors expecting immediate price acceleration purely because of a deficit risk misunderstanding the timeline through which commodity imbalances translate into price discovery. The same logic applies to industrial demand. Yes, silver demand tied to electrification, solar infrastructure, data centers, and semiconductor manufacturing continues expanding. These structural consumption drivers are real, they are measurable, and they are likely to remain persistent over the coming decade. But industrial demand alone rarely produces sudden price spikes unless it coincides with tightening financial conditions or investment allocation shifts. Commodity prices rise fastest when industrial demand growth meets monetary uncertainty at the same time. That combination, not demand alone, is what historically produces explosive upside moves. Now consider the argument that margin increases cannot change supply conditions and therefore cannot affect the long-term trajectory of silver prices. That claim is technically correct. Margin policy does not create new metal, it does not reopen mines, and it does not reduce industrial consumption. But it can dramatically reshape positioning inside the futures market, the mechanism through which prices are actually formed in the short run. This is why margin adjustments still matter even in a tightening physical environment. They influence who is allowed to remain in the trade. They influence how leverage is distributed across participants. And most importantly, they influence how quickly price responds to changing expectations. If leverage exits the market faster than physical demand enters it, prices can decline even while fundamentals remain constructive beneath the surface. That is not a contradiction. It is how commodity markets function. So the real question investors should be asking right now is not whether supply deficits exist. The evidence strongly suggests they do. The more important question is whether those deficits are being transmitted efficiently into price discovery or temporarily overshadowed by positioning adjustments inside the futures market structure. Because the answer to that question determines whether the current silver correction represents structural weakness or simply a transitional phase before the next allocation cycle begins. The final claim driving the current silver narrative is perhaps the most important one to examine carefully. Many investors are being told that margin increases represent a deliberate attempt to suppress the price of silver and protect institutional short positions. It is an argument that feels persuasive because it connects recent market behavior with emotionally powerful historical examples. But once we examine how clearing systems actually operate and what exchanges are required to do during periods of volatility, the conclusion becomes far less convincing. Exchanges do not exist to control price direction, they exist to control counterparty risk. That difference defines everything about how margin policy works. When volatility increases sharply and leveraged exposure expands across one side of the market, clearinghouses must respond. Their responsibility is not to protect longs or shorts. Their responsibility is to ensure that every participant in the system can meet obligations if prices move rapidly in either direction. Margin adjustments are the primary tool used to maintain that stability. And importantly, margin increases are applied symmetrically. They affect both buyers and sellers. They do not target one side of the market. This matters because the idea that exchanges selectively intervene against silver bulls assumes an incentive structure that simply does not exist inside regulated clearing systems. Exchanges earn revenue from trading activity and clearing volume. They benefit from participation. They benefit from liquidity. They benefit from functioning markets, not collapsing ones. So when margin increases appear during rallies, they should be interpreted as signals of rising volatility and rising leverage, not signals of institutional intent to suppress price discovery. Now consider the claim that commercial participants historically benefit from margin increases while retail investors suffer losses. There is some truth inside that statement, but not for the reasons often suggested. Commercial participants typically operate with deeper collateral buffers, diversified exposure across multiple maturities, and hedging strategies designed to manage volatility rather than chase price momentum. That allows them to remain positioned during periods when leveraged speculative capital is forced to exit. It creates the appearance that institutions are being rescued, while retail investors are being removed. But what is actually happening is simpler. Participants with stronger balance sheets survive volatility more easily than participants using maximum leverage. This dynamic exists across every futures market, not just silver. It exists in energy markets. It exists in agricultural markets. And it exists in equity index futures as well. Margin policy does not choose winners and losers. Balance sheet strength does. Now bring this discussion back to the present environment. Silver has rallied significantly from its 2023 lows. Speculative participation increased. Futures open interest expanded. Volatility accelerated. Under those conditions, margin adjustments were not surprising. They were predictable. In fact, they were necessary to maintain clearing stability as price ranges widened and leverage exposure increased across short-term traders. What matters now is not whether margins rose. What matters is what happens after leverage resets. Historically, margin-induced positioning adjustments tend to produce one of two outcomes. Either the market loses momentum because speculative participation disappears entirely, or the market rebuilds participation at stronger price levels after weak hands exit and stronger capital enters. Which outcome occurs depends not on margin policy itself, but on the macroeconomic environment surrounding the metal. And today, that environment remains unusually supportive of long-duration hard asset allocation. Fiscal expansion continues across major economies. Real interest rates remain unstable rather than structurally restrictive. Currency volatility persists across both developed and emerging markets, and industrial demand tied to electrification infrastructure continues expanding globally. These are not the conditions typically associated with the end of a precious metals cycle. They are the conditions typically associated with repositioning inside one. So the more productive question investors should be asking right now is not whether margin increases will end the silver rally. The more important question is whether the leverage reset currently underway is clearing the path for the next phase of institutional allocation into real assets. Because if history across commodity cycles has taught investors anything, it is this. The moments when leverage is forced out of a market are often the same moments when long-term capital quietly begins moving back in.